Welcome to the deep dive. Today we're really taking a magnifying glass to, well, the absolute foundation of any real estate investment. We're talking about the legal quality, the title of the asset you're actually buying.
Exactly. It's something people often, push to the side. They focus on the building, the rent, the location,
The shiny
the
parts.
shiny parts, right. But if that legal right, the title isn't solid, the whole investment can just crumble. It's worthless.
So this deep dive is about really drilling down into why trusting your title opinion isn't just like a good idea.
hmm
It's basically non-negotiable, a professional mandate even.
It is. We're talking mandatory steps, things you have to do to secure that legal foundation.
Okay, so our mission here is pretty straightforward. We want to pull out the essential knowledge you need about title security. And, maybe more importantly, talk about the serious professional and financial risk, the liability, when this kind of due diligence gets skipped.
Yeah, and for you listening in, the goal is to really grasp why relying on specialized title services, like getting title insurance, is absolutely core. It's fundamental to protecting yourself from, well, the worst case scenario, losing the property because of some hidden legal problem, a defect in the title.
Right. So it's not just about, say, a leaky roof, which is bad enough.
No, this is potentially much bigger. We're moving beyond just managing obvious risks. We're really analyzing the professional standard of care that's required in these deals,
No.
focusing specifically on those invisible risks.
Invisible risks. Like what, exactly?
Things like easements, maybe historical flaws in ownership, stuff that no physical inspection, no matter how thorough, is ever going to find.
Okay. So if you walk away from this just knowing how to avoid that kind of legal disaster, then, mission accomplished.
Absolutely. That's the key takeaway.
All right, let's get into this mandate then. Because the language our sources use, it's really strong. It's not just suggesting, it sounds like a requirement. Normally, in a purchase offer, you've got contingencies for the inspection, for financing, maybe an appraisal contingency,
Standard stuff.
standard stuff. But title quality, that seems to be treated differently. Why does it need this separate, specialized expertise? And why is it framed as, well, mandatory?
Well, two main reasons, really. The risk is total loss, and the complexity is just
Mm,
immense. Our sources are crystal clear on this. You must always rely on either legal counsel or proper title insurance for any opinion on the title's quality. That's not optional advice.
okay, must always rely. That's unambiguous.
It is. And think about what goes into a title opinion. It's not a quick check. It involves digging through a chain of ownership, legal transactions, sometimes going back 100 years or more, deeds, probate records, old mortgages, tax records, court filings.
Wow, okay.
It's a historical legal investigation. And frankly, a typical real estate agent or even the investor themselves just isn't equipped for that. You can't expect them to spot potential gaps in a deed chain or figure out if some long-lost heir might suddenly pop up with a valid claim.
So it's about replacing guesswork, or just hoping for the best, with actual professional insured judgment.
Yeah.
Makes sense.
Exactly. You need someone whose job it is to understand that history and stand behind their assessment.
But here's where it gets particularly interesting for me. The warnings aren't just aimed at the investors doing the buying. They're also aimed squarely at the professionals involved. What are the specific red flags our sources point out? What should an investor absolutely watch out for from their advisors?
This is a huge warning sign, and it's vital. People know this. Investors need to be really wary if any seller, or worse, any advisor they're paying, actively tries to discourage them from doing two things, two absolutely essential things. First, reviewing the public land records themselves, or having their lawyer do it.
Okay.
And second, buying title insurance.
So if someone you're paying for advice tells you, don't bother looking at the records, or title insurance, nah, waste of money.
That's not advice. That's a massive red flag. You've just identified a huge liability risk, probably for them and definitely for you. It's absolutely not a cost-saving tip.
Let's zero in on that advisor role, maybe a real estate broker specifically. Why is advising against title insurance seen as such a serious professional mistake? What's the actual liability for that broker who says, oh, just skip the title insurance, it's usually fine?
The liability is potentially catastrophic for that broker, and it all comes down to something called fiduciary duty.
Okay, fiduciary duty, explain that.
So, a fiduciary relationship means the professional, the broker in this case, has a legal obligation to act in their client's absolute best financial interest. They have to put the client's interest ahead of their own or anyone else's.
Got it. Protect the client above all.
Precisely. Now, when a broker tells a client not to buy title insurance, think about what they're doing. They are actively advising the client to reject the only mechanism specifically designed to protect them from a total loss of the property due to some hidden historical title defect.
So they're basically telling them to gamble with the entire investment.
Exactly. And the sources are blunt here. One source explicitly warns that a broker doing this is sure to be sued for negligence and breach of fiduciary duty.
Sure to be sued.
Right.
Wow, that's about as direct as it gets. How would that lawsuit actually play out? How is that breach proven?
Well, for negligence, you typically need to show 4 things in court. First, the broker had a duty of care to the client. That's usually established by the listing agreement or buyer representation agreement, the fiduciary relationship itself.
Okay, duty exists.
Second, they breached that duty. Providing advice that falls way below the accepted professional standard, like saying skip title insurance, is a clear breach. It's bad advice.
Bad advice check.
Third, causation. The client has to show they suffered harm because of that specific bad advice. So they followed the advice, didn't buy the insurance, and then boom, a title defect appears later.
Right. The harm is linked to the advice.
And fourth, damages. The client actually lost money. This could be the cost of hiring lawyers to defend their title, the cost of paying off an old lien they didn't know about, or, in the worst case, the entire value of the property if they lose it.
And that breach of fiduciary duty part? That sounds even more serious than just negligence. It's like a betrayal of trust.
It is, because it goes beyond just making a mistake. It implies the broker failed in their fundamental obligation to protect the client's interests. Recommending against a standard, universally accepted protection against catastrophic risk, that's a major failure.
Can you give an example, like a title defect pops up years later? Maybe an old ownership claim surfaces.
Okay, perfect scenario. Let's say an unknown heir from a previous owner suddenly files a lawsuit claiming the person who sold the property to your client didn't actually have the full right to sell it. Maybe they only owned half.
Okay, nightmare scenario.
Right. Now, if the client followed the broker's advice and skipped title insurance, who pays for the lawyers? Who pays to potentially settle with the heir?
The client says, out of pocket.
Exactly. Tens, maybe hundreds of thousands in legal fees. Or they could literally lose the property they paid for. The moment that happens, the client's new lawyer is going to look straight back at that broker's initial advice.
And the broker becomes the target.
Absolutely. Because that broker didn't just give questionable advice, they actively exposed their client to 100% of that title failure risk. They become the deep pocket target for the lawsuit that follows.
And we're not just talking about tiny clerical errors, are we? These title defects can be really substantial, rooted deep in the past.
Oh, absolutely. People often think, oh, it's probably just a typo. Sometimes, maybe. But often it's far more serious. These are the kinds of things title insurance is specifically designed to cover.
Like what? Give us some examples of these high-stakes historical issues.
Sure. Let's take forgery or fraud. Imagine someone way back in the chain of title forged a signature on a deed. Maybe they used a fake power of attorney or stole someone's identity.
Okay.
If you buy a property based on that forged deed, guess what? You don't actually have a valid title. The real owner or their heirs could potentially come back years later and reclaim the property. No amount of standard broker due diligence would likely uncover that past fraud.
Wow. Okay, what else?
How about undiscovered heirs or missing wills? Someone might have died without a clear will intestate. The property goes through probate, gets distributed, then sold. Years later, a previously unknown relative surfaces, maybe from a first marriage, with a totally legitimate legal claim to a share of that property because they were missed in the original probate.
So the title wasn't cleanly transferred.
Exactly. It challenges the validity of the sale to the next person and potentially down the line to your client.
Okay, that's scary. Any others?
Yeah, think about prior easements or restrictive covenants. Maybe there's a recorded easement giving a utility company the right to dig a trench right where you plan to build an extension. It's invisible on the ground, but it's legally binding. Or maybe an old neighborhood covenant recorded 80 years ago says you absolutely cannot run any kind of business from the property. And your whole plan was to run your consulting business from a home office. Poof, investment plan destroyed.
And a standard title search, if done properly, should find those.
A good title search aims to find those recorded items, yes. And if something is missed by the title company, that's exactly what the title insurance policy is for, to defend you against those missed items or pay for the loss they cause.
So that broker advising someone to save, what, maybe $1,500 on an owner's title policy?
Yeah.
They're essentially setting their client up and themselves for a potential $250,000 legal battle down the road.
That's a perfect way to frame the risk calculation. It's completely asymmetrical. The professional standard isn't just about doing a decent search, it's about advising the client to get the insurance, the financial backstop against the residual risk, the things that even a great search might miss, or the things like forgery that are almost impossible to detect just from records.
So advising against that insurance.
It's a willful disregard for the client's financial safety. That's the breach of fiduciary duty right there. Title insurance is the highest level of risk mitigation you can get for these specific historical legal risks in the whole real estate process.
And it's not just about being good title, right? It has to be marketable title. What's the difference?
That's a crucial distinction. Marketable title means the title is clear enough that it can be readily sold or mortgaged to a reasonably prudent buyer or lender. If your title has significant defects, even if you technically own it, you might not be able to sell it later. A future buyer's title company will flag the same issues, or you might not be able to refinance because the lender won't accept the title as collateral.
So the asset becomes illiquid,
Yeah,
trapped.
exactly. The clarity of the title directly impacts its marketability and, therefore, its value and utility as an investment. If a title company won't issue insurance on it because the title is too messy, that property is effectively off the market until those problems are fixed, which can be very expensive or sometimes impossible.
Okay, so we've established the absolute need for professional protection relying on counsel or title insurance. Let's shift now to the actual legwork, the due diligence side. The investor still has a role, right? What does the legal part of due diligence look like for the buyer?
Yes, absolutely. The mandate to rely on professionals doesn't mean the investor just sits back. The sources emphasize this. The investor must engage in your own due diligence review. Now, on the legal side, what that primarily means is carefully reviewing the title report provided by the title company and potentially digging into the underlying public records if necessary, usually with their attorney.
Okay, the title report.
Yeah, for a serious investor, this review should be just as critical as, say, analyzing the cash flow projections or the IRR.
You're linking the title report directly to the financial metrics.
Yeah.
How does a title flaw, like an encumbrance you mentioned, actually mess up the numbers, the IRR or NPV?
Oh, fundamentally. Because every single financial projection, your expected rent, your operating costs, your future sale price, assumes you have clear, undisputed ownership and the right to use the property as planned.
Right.
So if that title report comes back and reveals, say, a big unexpected lead from a previous owner's unpaid debt, suddenly your cash flow projection is shot because you might have to pay that off to protect your title. Your net present value just tanked.
Okay, that gets the cash flow.
Or what if it reveals that restrictive covenant we talked about? Maybe it prohibits the multi-unit conversion you were banking on for higher rents. Your projected income disappears. Your internal rate of return calculation, meaningless now.
So an encumbrance is like a hidden cost or a usage restriction that just torpedoes the original deal math.
Precisely. It fundamentally changes the risk-adjusted value of that investment.
Yeah.
It can easily turn what looked like a great deal on paper into an absolute financial disaster.
Which makes that title report incredibly important. It's the document that reveals these potential financial time bombs. So what exactly is it? How does the title company create this report?
So the title report, sometimes called a title commitment or preliminary report, is essentially the summary of findings from the title search. The title search itself is like a forensic examination of the property's legal history. A specialized title examiner does this. Their job is to check specifically for what, if any, encumbrances exist against the property.
And where are they looking?
They're diving deep into the public records. We're talking official county records, deeds, mortgages, mortgage satisfactions, judgments, tax liens, probate court filings, sometimes divorce settlements, plus municipal records for things like zoning and special assessments. It's a meticulous process.
Okay, let's nail down that term, encumbrance. You mentioned it before. For someone listening, what exactly is an encumbrance, legally speaking? What kind of burdens show up on the report?
Right. So an encumbrance is basically any legal right or claim on the property that's held by someone other than the owner. Crucially, it doesn't usually stop the property from being sold, but it does diminish its value or restrict how it can be used.
So it burdens the title.
Exactly. It burdens the title. And these are pre-existing, non-physical risks hidden in the legal history. We can generally group them into a few main categories that buyers really need to pay attention to.
Okay, like what?
First, you've got liens. These are financial claims, money owed. The title search looks hard for these. Think unpaid property taxes, that's a tax lien, usually first priority, existing mortgages that haven't been paid off, judgment liens, maybe from a lawsuit the previous owner lost, or mechanics liens if a contractor did work and never got paid.
And if you buy the property without knowing about a lien?
If that lien wasn't found or dealt with before closing, it generally sticks with the property, meaning the new owner, you might become responsible for paying that debt if you want to keep the property free and clear, especially if you want to sell or refinance later.
Yikes. Okay, so liens are financial claims. What else?
Second category, easements. These aren't about money owed, they're about usage rights granted to others. A really common one is a utility easement. The power company, water company, they have the right to access their lines or equipment on a portion of your property. Usually not a huge deal, but you need to know where it is.
What about more restrictive easements?
Right, those can be bigger issues, like an access easement, sometimes called an easement for ingress and egress. This could mean your neighbor has the legal right to use part of your driveway or land to get to their own property. That obviously restricts what you can do with that part of your land. You can't block their access, you can't build on it.
Okay, liens and easements is the third type.
Third, we have restrictive covenants and conditions, often called CC&Rs, covenants, conditions, and restrictions. These are rules about how the property can be used, and they're usually written into the deeds when a subdivision is first created. They run with the land, meaning they bind all future owners. Could be anything from limits on building height or architectural style, like you must have a brick facade, to rules about fences, sheds, or even what color you can paint your house. And importantly for investors, they often prohibit certain types of commercial activity or maybe limit the number of unrelated people who can live there, potentially blocking a rental strategy.
So that distinction between a lien and a covenant is pretty important. One hits your wallet directly, the other hits your plans for the property.
Exactly. One is a financial burden you might have to pay off. The other is a legal restraint that might make the property unusable for your intended purpose. Both seriously impact the investment value.
And the title report. Its job is to list all of these discovered issues.
Yes. The report, specifically the exceptions section, lists all the encumbrances and other items the title company found that will not be covered by the title insurance policy unless they are cleared up before closing.
So it's basically a list of problems you're inheriting.
Pretty much. It's your roadmap to the title's problems. A smart buyer, working with their attorney, doesn't just glance at this list. They scrutinize every single exception. They figure out, what does this mean financially? What does it mean for my plans? Can this be fixed? Do I need the seller to fix it before I close?
Which brings us back to that split you mentioned earlier, separating the physical check from the legal check during due diligence.
Right.
The physical condition, that's covered by your home inspection contingency, right?
Yes, typically. Source 32 points this out clearly. You use contingencies for the physical state.
So why do we absolutely need to treat the legal review, the title review, as a completely separate process? Why can't the home inspector just, check the title too?
Because they are fundamentally different inquiries requiring completely different skills and addressing entirely different types of risk. The property inspection answers the question, what's physically wrong with this building and the land? What needs fixing? And roughly what will it cost?
Okay, physical condition, repair costs, tangible stuff.
Tangible, visible, generally insurable through a standard homeowner's policy, or fixable with money and contractors.
And the legal review, the title, search, and report.
That answers a totally different question. Who legally owns this property, free and clear? And what hidden historical claims or restrictions are attached to it that might affect my ownership or use?
Intangible historical risks.
Exactly. Intangible, rooted in past legal events, and the primary protection is title insurance or legal action to quiet the title. You need different experts. You rely on the inspector for the physical. You must rely, as Source 32 says, on legal counsel and the title company for the legal state, for the title opinion. There's no substitute.
Maybe an analogy helps here. Let's say you're buying a classic car.
Okay.
The physical inspection is like having a mechanic check the engine, the transmission, look for rust. That's your inspection contingency.
Makes sense.
But the title, due diligence, that's like running the VIN number, checking the car's history report. Was it ever reported stolen? Does the seller actually hold a clear title? Or is there an old loan, a lien attached to it? Does the VIN on the car match the VIN on the paperwork?
Good analogy.
You'd never drop serious money on a classic car without checking both its current mechanical condition and its legal ownership history, right?
Absolutely not. And it's the same principle in real estate. only the stakes are usually much, much higher, millions of dollars potentially. So the due diligence has to cover both. The physical structure, checked by the inspector, and the legal history, verified through the title report and backed by the title insurance policy.
So an investor who maybe gets really good at analyzing deals, calculating cash flow, managing properties, but skims on the title review.
They're building their entire financial future on potentially shaky ground. It's like building a skyscraper on quicksand. They might have the world's best spreadsheet predicting profits, but if an undiscovered easement prevents development, or a massive tax lien suddenly appears and wipes out their equity, all those beautiful calculations become completely academic.
And that really underscores why that professional advice against title review is so incredibly dangerous.
Yes.
It implies that just checking the numbers is enough. It ignores the fundamental fact that the quality of your legal ownership is the actual asset that makes all those financial metrics even possible. Without clear title, you don't really own the projected cash flow.
It creates this huge unnecessary vulnerability. Look, sophisticated investors, the ones who last, they understand risk management across the board. Market risk, physical risk, and legal risk. Title insurance is the primary definitive financial defense against that legal risk category. It transforms an unquantifiable, potentially catastrophic threat, like losing the property in an ownership dispute, into a known, manageable, one-time cost, the insurance premium.
And distinguishing between the lender's policy and the owner's policy is important here too, right?
Oh, absolutely critical. When you get a mortgage, the lender will require you to buy a lender's title insurance policy. This protects their interest in the property up to the loan amount.
So that protects the bank.
Yes, it ensures the bank has a valid insurance. But it does not protect the buyer's equity, the down payment, any appreciation.
Okay, so the buyer needs their own protection.
Exactly. That's the owner's title insurance policy. This is usually optional, but highly, highly recommended. It protects your equity, your ownership rights, for as long as you or your heirs own the property. It covers the full purchase price, typically.
And it's usually a one-time fee paid at closing.
Correct. One premium, paid once, and the coverage lasts potentially forever for you and your heirs. Given the risks we've discussed, forgery, missing heirs, undiscovered links, the relatively small cost of an owner's policy is almost always a worthwhile investment for peace of mind and financial security. Skipping it to save a few hundred or even a couple $1,000s on a major purchase is, frankly, penny wise and pound foolish.
So the due diligence, reviewing that title report, it's also about understanding the difference between the exceptions listed. Some might be minor, easily fixed. Others might be deal breakers.
That's a key part of the review. You need to differentiate. Maybe the report lists a small old judgment lien against the seller that just needs to be paid off at closing from the seller's proceeds. Okay, manageable. That can usually be resolved.
But what about something bigger?
What if it lists that major access easement we talked about, running right through the middle of the lot that might be permanent, impossible to remove? Or a fundamental flaw in the deed history suggesting the seller doesn't have full ownership? Those are potential deal killers.
So the review informs the negotiation or the decision to walk away.
Exactly. It gives the buyer leverage during the due diligence period. You can go back to the seller and say, you need to fix this defect before closing, or I need a price reduction to account for this issue, or if it's serious enough, this isn't acceptable, I'm terminating the contract based on the title contingency.
And it lets you react before you're locked in.
That is the entire purpose of having a due diligence or contingency period. Uncover the problems while you still have the contractual power to address them or get out cleanly.
And thinking about the reliance on professionals again, it's not just about the insurance policy payout if something goes wrong later, is it? It's also about the expertise that title company and your lawyer bring before closing.
Absolutely. The search process itself, the examination, the identification of issues, and often the title company helping to cure minor defects before closing, that's a huge part of the value. They are working to ensure the title is insurable and marketable before you even take ownership.
So the insurance policy is almost like the safety net, but the primary goal is to fix problems up front.
That's a great way to put it. The search and the report are the tools to identify and resolve issues proactively. The insurance policy is the ultimate backstop for things that might have been missed or are inherently undiscoverable, like that historical forgery.
Which just reinforces again why any advisor telling you to skip the search or skip the owner's policy is fundamentally failing your duty to protect you during that critical pre-closing phase. They're telling you to ignore the problem-finding stage and discard the safety nets.
Double malpractice, potentially.
Okay, this has been a really insightful deep dive. Let's try to summarize the absolute must-know takeaways for anyone involved in real estate, especially buyers. First, that professional mandate seems crystal clear. You have to use either experienced legal counsel or a reputable title insurance company to get an expert opinion on the quality of the title. You can't DIY this part.
It's non-negotiable. It's the only reliable way to assess and hopefully secure the legal history and ownership of the asset. Relying on anyone else or skipping it is taking an unacceptable risk.
And second, the buyer's own due diligence is crucial. You or your attorney need to actively review that title report. You need to understand the encumbrances, those liens, covenants, easements, because these hidden legal issues can absolutely destroy the financial viability and the marketability of your investment.
Check the report, understand the exceptions. Don't just file it away. These aren't just technicalities. They represent real financial risks and usage limitations.
And the warning from our sources is stark. Title insurance, particularly that owner's policy, isn't just some optional closing cost fee you can negotiate away. It's fundamental protection. You absolutely have to push back on, or frankly probably fire, any advisor, even a paid professional who suggests skipping this. They are, maybe unknowingly, maybe negligently, exposing you to potentially catastrophic financial loss.
That's right. That simple act, making sure the public records are reviewed thoroughly, and then securing an owner's title insurance policy, that is the bedrock path to financial security regarding ownership risk in real estate. And as we discussed, the professional who advises against it, they're not just giving bad advice, they're placing themselves in serious legal jeopardy, negligence, breach of fiduciary duty. The severity of that potential legal fallout really highlights how important title protection is considered.
It really boils down to the quality of the advice you get and the professionals you choose to rely on, doesn't it?
It does.
Knowledge is knowing these risks exist. Wisdom is knowing you need qualified experts, title professionals to navigate and mitigate them.
Yeah.
You don't need to become an expert in 19th century deed records yourself.
Please don't try.
Right. But you absolutely need to know enough to demand that your team secures a clean, marketable, and insured title for you.
Well said. And maybe a final thought to leave people with. That knowledge, the understanding that title quality must be professionally verified and insured, is arguably the single most valuable piece of intellectual capital you bring to any real estate closing table. Because if you fail to secure clear, undisputed legal ownership through this process, you haven't really bought an asset. You've bought a potential lawsuit. You've bought an ongoing legal problem waiting to happen.
Owning a legal contingency, not an asset. That's powerful.
Protecting your title isn't a cost center in the deal. It's the absolute prerequisite for realizing any future value, any financial success, any ability to leverage that property down the road. Don't let an invisible flaw from the past undermine your entire investment strategy.
Excellent point to end on. Thank you for that deep dive, and thank you for joining us.